Hey, good morning, everybody. Welcome to the Ankerstar Wealth Morning Show. Markets are in the green 2 days in a row. Yes, right after the ugly Monday that we had for sure. So we're going to start off this morning. Mike's going to talk about the market. He's going to talk about they came out this morning, specifically Disney, the House of Mouse. I visited Disneyland with the family and gave them some Ankerstar dollars for sure, or this past quarter. So maybe the report about how much I spent there actually. But the Disney's going well. They've had a couple of movie releases that are going good. So Mike will talk about that. Mike will also then talk about the relationship. We talked about the 10-year Treasury a little bit as the good news on Monday. I know. Monday was ugly, but there's always good news right in there. And that part of that big sell-off was the 10-year came down significantly, bounced a little yesterday. But why do we care? Well, a lot of people listening to this own homes, right? So depending on your mortgage rate, maybe there's a refinancing opportunity. Certainly, if not now, later on as rates are forecasted to drop here in the next 6 weeks to 18 months, somewhere in that time span. And then I will close with annuities. You might have heard me talk bad or talk down about annuities, but hey, I'm going to give you the honest scoop today. Why they're wrong most of the time, but there are situations where they can be right. So listen until the end. This is financial education presentations. You have to do your own due diligence before acting upon anything you hear in this presentation. More disclaimer information is available at AnkerstarWealth.com, and the opinions expressed are mine and Mike's alone. And let's start with Mike's.
All right. I want to start with some more green, very similar to yesterday's start. I love looking and seeing green across the board. And then, of course, the red I explained yesterday, the VIX going down, the fear gauge going down. So right now we're showing, we're 20 minutes into the market open. The NASDAQ, which is what I pay most attention to, up 1.8%. That is fantastic news for Ankerstar Wealth investors. We like that. But I want to get in specifically to the House of Mouse, or, I don't know. I want to change it to the House of Marvel because I think that's more important, at least at our age group. But, and Disney came out with earnings and they beat. Let me show you this. Earnings per share, $1.39 versus $1.19 expected. Revenue a little bit higher, and you say, "Wow!" Like if this was your parent and this was your report card, you're like, "What? I thought you were going to get a B, but you got a B plus. That's pretty good." How did the market respond to this? And I'm going to show you the market is beating down on Disney. It's down 3%, kind of surprising. And I'm going to go back and just show you a little bit more data on this. Where they did well is the streaming business. So, obviously the Disney Plus and Hulu and ESPN Plus is what they have. That actually made a profit for the first time, and that was a quarter earlier than they had expected. So you say, that seems like good news. Now, where did they lose money or did they not make as much money as expected was in the parks. And they said that's due to inflation and consumer demand. So we've been talking, the economy's slowing. When you have optional expenses, you don't just decide to go spend $5,000 at the Disney parks for your family. Of course, that makes sense that went down. I'm surprised the market's selling off or, 3%, but when you look at the overall trend, and this is the Disney year-to-date graph, you can look at it from the beginning of the year and say, wow, it's about break even. It's about where it started the year at. But of course, there was that slight 50% uptick into April where it peaked. And you can see this is the effect of consumer demand in a slowing economy. I think going into April, it was like, oh, we're definitely going to have a soft landing. Things are going to continue high flying. And then this demand dropping off. Is this a buying opportunity? It's almost at its 52-week low. In fact, I want to just step back a little further and look at the graph. This is the all. Let's just look at it since 2009. You can see a massive spike, 2021. Maybe that was the government giving all that money out to people and everyone's like, I'm going to Disney with that money the government gave me. But it really spiked. But it was also the same time that they released, Disney Plus and said, we're going to go compete with Netflix, which I'll say I think they've been moderately successful. Netflix was the first one there, and obviously Disney Plus is making money now. And when it comes to these streaming services, and there's so many of them now, I mean, I'm overwhelmed with even how many I have, and I don't have possibly enough time to justify the cost of all of them. I think Disney's one that I like just because I like Marvel and I like the play Hamilton, which is on there as well. So if you're Disney and you've got a product that people like Disney Plus, what should you do? What are they doing? This came out too. They're raising the prices. That's in the past.
Yeah.
Yes, in the past, we've seen this in a couple different places. Netflix, Planet Fitness. We've seen it, and it generally makes the stock go up. It's like we raise prices. I'm sure a couple people would drop because their price went up $1 or two, but most people, myself included, are like, it went up $1 or it went up $2. I'm not really worried about it. I'm just going to eat that cost and basically pay more into the company. But Disney did this, and stock still sold off. So, where's Disney going? It's not in our models. I'm not planning on adding it at this point, even though it does look to be on sale. With the slowing economy, I imagine the park business is going to continue to maybe what they'll do is they'll lower the prices because it is pretty expensive. Maybe they'll lower the prices to bring in more consumers. Who knows? So that's Disney.
I have a comment, Mike, if I could,
Go ahead.
before you transition. Sure. I would say in investing, especially in individual stocks, you talk about the horse and the jockey, and the jockey being the leadership team, if not the CEO. And I would say Disney is a perfect example of how the horse, the theme parks, the streaming, the merch, the everything about the brand is so strong. It would be a no-brainer investment, except for the leadership team, which has been, the CEO's retired and come back out of retirement. It's like nobody can manage this correctly for some reason. It's just like, how could these people be, have botched this and they continue to do it? It's like, and now you look at the theme parks, and I'm always amazed when I go there on how expensive it is. It's like, yes, we're very blessed, we can afford to pay that, but wow, have they priced out like so much of the population? It's like, how could you possibly not make money off of this? And the same thing, raising prices with the streamers. Yeah, sure, a lot of us can go, okay, a buck or two there, but when the bottom 50, 60, 70% of the country is getting squeezed economically, I don't know. It's like finding a way to snatch and defeat from the jaws of victory with Disney, like year over year over year. It used to be, hey, if your kids buy them a share of Disney and it'll just go straight up. That has not been the case. So, all right, enough negative on Disney. Back over to you, Mike.
I have to give a funny example. I remember 20, 30 years ago, barely, but someone saying, hey, here's a great way to save money, make money, whatever. Buy the Disney movies on VCR when they come out and hold them, and they will go up in value because these movies are timeless.
Vault. Yeah.
Yeah. And I think that probably didn't work because I don't think anybody had VCRs. And once you bought this subscription, you're like, oh, what do I have all these tapes for? I don't even have a VCR player. So I'm glad I did not follow that strategy, but someone told me that. So let's talk about the 10-year bond against refinancing. So the 10-year bond, it dipped on Monday. We're always looking to pull some good news out of a sell-off besides buying things on the cheap. But here, if I look at a 5-day graph of the 10-year bond, you can see this big drop. Yay! That means and when you refinance or you finance with the bank your mortgage, it generally is tied closely to this 10-year bond. I guess I've studied it enough when I've refinanced to know that. Every time when the bond would drop and I was getting ready to finance, I'd be like, call the bank. What's the latest rates? Give me the best deal. So, they recovered some. But I'm going to show you the 5-year graph, and you can see why, boy, it seems like an eternity ago. But 3 years ago, you could get 3% 30-year fixed mortgages. And that's because the 10-year bond was under 2%. Now, is it going to go down? Yes, it will continue to go down as the Fed discounts rates. as people shift money from here to there, as far as buying opportunities, so we're going to see this happen. Now, should you wait? And that was always the question I wondered when I was refinancing my house. Like I want to say the first time I did it, I went from a 6 down to like a 4, and then went down to a 3. So I refinanced, and every time when you refinance, there's certainly costs involved with it. So, if you just recently refinanced at a 7% or financed the house at 7%, would you refinance if it went down to 6.5? And I'm pulling up an article that says, mortgage refinances, soars 16%. I don't know if that's soaring, but anyways, 6.55. Me personally, I would not refinance at that unless you just had to, because I believe it's going to go down further. I mean, that's my belief, and I would wait. I want to say there's a kind of a cost justification, at least I did in my mind, is like, hey, if I can save, 1.5%, the break even is only maybe 6 months to a year, for the cost of refinancing. These are the decisions you're going to have to make if you are refinancing. If you're buying a house, you got to buy it. You can't just like wait for rates to go down to buy houses. You have to make that decision. Always remember that, the purchase price of a house is locked in, but the actual interest rate as it drops, you can refinance. So there's a good news there that as it goes down, you can reduce your cost. How this goes over this next, like Steve said, anywhere from, 60 days to 18 months. As the Fed reduces the rates, I mean, these should go down. Is it going to get down to 3% again? I wouldn't hold out for that. I mean, that seemed like I don't want to say once in a lifetime, but it was a long time that it was there. It's not likely to get there anytime soon unless we have some incredible market sell-offs, which we do not want to have. So with that, I will turn over to Steve in the exciting world of annuities.
Well, you're absolutely right, Mike, about annuities not being that exciting, but you're also right about what, the schedule of which you refinance is totally up to you. Each refinance, if you really break into the charts, it's going to cost you like $10,000, but they spread it out over 30 years. So they make, it's not noticeable, but just realize that, yeah, there's like 10 grand baked in there. The banks are not fiduciaries. They're not in your best interest. They're just executing a transaction for you. So I've kind of tell folks, if you're around 7, you just bought or whatever, because you had to, right? You move because life says it's time to move, and then you manage your mortgage, the best you can. I would say wait till below 6 if you want to do it the first time, but after that one, wait till below like 4.5 would be the next time. Anyhow, it's all up to you, but try not to be the serial refinancer. Otherwise, you'll be getting like cookies in the mail from your bank because they love you, because it's 10K a pop. They extract that money, that goes to like somebody's like pocketbook and leaves, right, when they can talk you into a refinance. So it's not always a great idea. Another interesting thing that we've seen here is that now if you still have the old mortgage that's like 3% or below, when you think basic accounting, okay, yawn, what's less exciting than annuities? Accounting, you're right. But you think of assets and liabilities, right? You want to buy assets. Everybody's like, okay, I know, I've heard Steve and Mike talk about that. You buy assets and hold them for a long time. Liabilities, you get rid of those. Unless your liability happens to be a, $500,000 loan. Say you have a nice big house, $500,000 mortgage that's below 3%. That's actually an asset. Now it's on the wrong side of the balance sheet. But yeah, a lot of people aren't moving because they don't want to break this fantastic deal they have on the cost of capital. So anyhow, new way to look at things. But let's also talk about a new way to look at things in the fact that I want to show you our website real quick because we're going to transition into annuities. And all right, here we have our website pulled up. And one thing we want to talk about is there's advice and then there's people that are selling you things. So we talked about the bank, they stand to make money off of all these transactions. So if the rate's at 6.6 and a quarter, you want to refi at 6%, they will be like, yes, not should you. But like, yes, let's go in and talk about it because they will. So you see our website here, which is one of my favorites, right? Because it's got an airplane on it. But if you'll scroll down just a little bit, Mike's driving here due to technical difficulties. But you can see there in bold, as fiduciaries, we recommend strategies, not products. So when you're talking to a fiduciary, we give you the honest scoop on everything. Is it a good idea? Should you? and not just the actual transaction. But same with insurance, it's a product. So we're going to switch over to Investopedia here and talk about what is an annuity. So you see that an annuity is an insurance contract. So they're selling you this product, right? So right away, so let's divorce the should you. Let's just talk about what it is. So you have, when you talk about insurance, you're mitigating risk. Okay, that's the purpose of any insurance, is you're taking risk, you're paying a small amount, a premium, if you will, to spread risk to someone else, whether it's life insurance, car insurance, house insurance, whatever insurance. J-Lo insured her legs or something at the Lloyd's of London, with athletes insurance, whatever it is, right? There's always somebody on the other side listening going, now what do you want to insure? And then they come back to you with the contract. So they draw the contract, and that's probably the important part to think here. So have you ever seen an insurance company advertise? Oh, I don't know, everywhere. And they sponsor football teams and build stadiums and stuff. So guess whose back that money comes from? Yours. Now, I'm not saying it's bad. I'm just saying understand what you're walking into. Do you get to bring the contract like, hey, I'm going to write some terms up and I'm going to go approach the insurance company and see if they agree to my terms? No, that is not how that happens. Please, if you try that, please videotape it, because you'll go viral on social media if you try to walk in and say, here's my contract. Do you agree to it? Yes or no? No, that's not how it works. Is you approach them, and guess who they have on their side trying to, life sometimes is a big math competition, and who can outmath whom? Yeah, they have actuaries that are like, really good. Now, I mean, not there are bad actuaries. Probably all actuaries are good at math. But, I mean, they are better than you. I don't care if you got a perfect score on the ACT in math, Mike. You still, which he did, which is annoying, but that's why I hired him. I'm over it. I've let it go. Okay, maybe I haven't let it go at 54. Anyway, but yeah, even Mike can't outmath a whole team of actuaries. I mean, you try, but he can't, right? So they go and they look at all the math behind this, and you're like, well, I think I'm getting the better deal. You're not. You're not getting the better deal. They're always getting the better deal. They draw the contract. They present the terms to you under a take it or leave it format. You can't go, well, how about this? And they're like, sign here or don't sign. We don't care. But either way, so once you enter the contract, you already know that you are not getting the best deal, right? Because they have looked at the deal. They need to make money. They need to pay the salesperson. They need to pay the actuaries. They need to sponsor football teams, stadiums, run all their advertising. That's not free. So you're going to pay for some of that. So they have to charge you a premium. Right? So right there in the terms, even if you got past like 8th grade English, you probably know that premium means you are paying for more than what you are getting. So they're not even hiding this from you. So you're paying an insurance premium. Okay. So you are entering a relationship where you're paying more than what you're going to get. Right. And unless you can think you can outmath the big insurance companies, which you can't. So, but when is it right? So it's right under a couple, and we're talking pure annuities and investing here, is if you know yourself and you are not good with the emotional fluctuations of the market, which you're not. We just had a big event on Monday. A couple of the advisors did report, me being one of them, getting those phone calls of I can't lose any more, let's sell the cash, all of that stuff. So, the market is a roller coaster. We try to make sure that you understand that up front. Your risk score is what type of roller coaster you're getting on. So don't get on the big roller coaster if you're not going to enjoy it, right? Don't get on it. Get on a smaller coaster or a flat coaster. Well, with an annuity, you're really getting on the ultimate flat coaster, right? You can go into CDs and stuff if you're using, an advisor, or if you're savvy enough to do it yourself. But the annuity is even like priced below that. So when you lock into terms of an annuity, you are agreeing to generally a lump sum of money up front, and then you get a payment schedule, whether that starts now, immediate annuity, starts later, deferred annuity, but some sort of contract where the money gets piecemealed back to you. You can do it on your own. If you're using an advisor, just tell us what you're trying to do. We can set your portfolio up that way. If you don't want to work with another human being, if you'd rather just pay the insurance company to take care of this for you, you can do that. Who would it be right for? If you hit retirement and you've looked at the amount of money you have and said, ooh, I'm here, because sometimes retirement shows up on your doorstep, through like getting laid off or injured, or you can't do your primary job anymore, whatever reason. But you're like, boom, I am here. I'm at this retirement phase, and I do not have enough money to live the retirement that I had hoped. So therefore, and I would say traditionally that's that. Like $350,000 to $500,000. If you have that, it may be right to enter an annuity, because you really can't accept much downside because your money won't last. So it's hard to get on the coaster and then have Monday happen. So then you could lock into an annuity. And then then you take your lifestyle. So instead of adjusting your investments up or down, you're taking your lifestyle and adjusting it down to whatever that annuity pays. And you have that annuity income, and you have Social Security, and boom, that's it. No more mathing for you for the rest of your life. The insurance company loves to take the deal, because what does the insurance company do? They lock you in at a payout, call it 4%, or the hard number, a raw number, and they take your money and they get on the big coaster and they make all kinds of money. So they don't just make it off premium, but they make it in the opportunity cost of what your money could have made if. Right. So it's like a super, super lucrative for them, but you do get the safety. So that's what you're buying, is safety and security there. You can do it on your own. Mike and I can show you how to do that, not on your own, but through an advisor. We can construct your portfolio to do the same thing. But hey, if you entered an annuity, there it is. And then if you're already in one, don't beat yourself up. Sometimes you can break them. If you've been in it long enough, the insurance companies let you out for free. They've made enough money off of you. If they haven't made enough money off of you, then generally it's 10% of the face value. They'll let you out of the contract. You'd have to discuss whether that's right for you and the terms and specifically at the time. But if you sign on with Ankerstar Wealth, they're like, hey, send me your annuity, right? It's 30 pages of legalese set to confuse, if you will. There's generally one page in there that has the terms you need on it. We can kind of take a look at the math for you, show you the cash flow that you're getting, show you what you're paying, show you what the opportunity cost is, meaning take that money, invest it elsewhere. So we can really dig into this for you if you're interested. So that is enough on annuities. Hey, Steve, but Mike, I know. I'm
one
like
question.
teeing it up.
No, I'm gonna set you up for a question here. What happens if I take an annuity versus I invest it? When I pass away, how does that affect my heirs?
It does depend on the type of annuity, but generally that money's gone. Generally, you've entered into a contract to where you're going to get a set of payouts and not payout of nothing but the end. However, it's a great question. We literally did not plan this. If you're like sitting there like, why would I hand over my life savings if my survivors don't get anything? And the insurance company goes, you bring up a great point, Steve. For another $20 a month for the next 40 years, we can cut a survivor benefit to you and put a rider on top of that guarantee. So you're basically buying almost like a life insurance policy at the end of it. So you can get, and literally they draw the term. So it's like, hey, what do you want? A guy with like the watches, the coat with the watches on the street is like, what do you want, man? What do you want? So if you want to put a rider you tell them what rider you want, and then they will go back to their actuarial team and figure out how to overcharge you on that too, to put that as part of your contract. So generally you're going to lose it versus if you put it in an investment portfolio and set it to generate income, you get all that income and then your heirs get the money that's left over. So good question, Mike. Anything else to add, since you do have some insurance background?
No, I dealt more in the health insurance world, which is day to day rather than the life insurance or way out. So thank you.
All right. Well, good stuff. A lot of useful information today. I know we went a bit long, but you can tell when Mike and I are giddy 2 days in a row of green after a big red day. So like bringing these topics to you. And with that, we will see you guys back tomorrow. You guys have a good one. Bye.